Hello, everyone. Welcome to Bitcoin Not Crypto. I'm Forrest Hodel, and today I am joined by Peter Dunworth from Bitcoin Advisor. I just had, who was it? I had George Bodine on, Jethro, and he said, I quoted him, or I called him the man who's more bullish than Sailor, and he said, I'm extremely bullish, but there's two people who are more bullish than I am: Samson Mao and Peter. And I thought that was kind of cool. So I wanted to see, why are you so bullish?
Gosh, that's huge shoes to fill there with George and Samson and Sailor. Um, I just think having a look around at where we are at this point in time, there's been never been a better time for Bitcoin, and so although I've been bullish for a long time, I think where we are at this moment in time, there's never been a better time for Bitcoin. We've got institutional adoption starting to flow through. We've got the advent of the Bitcoin treasury companies. Saylor has sparked an entire industry himself and copycats, which I think is a wonderful thing. Yes, there may be some collateral damage from companies who are doing it poorly, but this is really opening up the capital floodgates to Bitcoin. And I look at this and think there are two major vectors or liquidity streams that I look at that I know aren't being applied to Bitcoin at the moment. And maybe this is the next shoe to drop in the next 2 to 5 years, but one of them is um, all oil and gas to be denominated payments in Bitcoin. Now, there's been some talk about that, but that's a $10 billion a day industry that needs $10 billion of purchases. And the other, which is probably going to dwarf that, is the bond market. And with the advent of Bitcoin bonds, principal protected notes, once the banks figure out how much money they can make out of this, they are going to be putting all of these structured products to market. And just at a very high level, there's 60 to 70 trillion dollars worth of bonds that gets refinanced every year. And my expectation is, with the rates where they are at 4 to 5%, there's an opportunity to put somewhere between 10 to 20% of that issuance into Bitcoin, into a principal protected note. And I had a chat just yesterday with CJ, talking about his principal protected notes, and he's talking about putting 20% of a bond issuance into Bitcoin bonds. And what that means from a dollar perspective is that would be somewhere between $5 to $15 trillion worth of capital flowing into Bitcoin every year passively to support the bond market. And now, what's really interesting about this is that's really great for governments, because now all of a sudden they've got a buyer of their bonds, whereas at the moment there's no market for it. In addition to that, that's a whole host of liquidity funneling into Bitcoin that's going to recapitalize our entire banking system. Because one of the biggest problems that we've got is we we don't have a debt problem. Everyone talks about us having a debt problem, thinking that's a major issue, and yes, it is. But you only have a debt problem when there's no collateral to repay the debt. So the problem under the problem is the fact that there's no there when it comes to claiming your collateral from the debt that's owed to you. And so what we're going to see, and this is where I'm so excited about these principal protected notes and Bitcoin bonds, is this has a way to recapitalize the entire financial system, while at the same time pumping trillions of liquidity into Bitcoin on an annual basis. So um, we're set for all of this in front of us, and it's going to start as a trickle, and then it will end up as a flood. But knowing where we are in the capital stack right now and who are the players, we haven't even reached major adoption with the governments. We've talked about strategic Bitcoin reserves, but I've been talking for 5 minutes on multiple different things that tell you this price is going to go a lot further. And there are so many liquidity streams coming on board that we can't even begin to comprehend. But they're just a few of them, and I think the party's just getting started. And most importantly, is we've had the investment of Bitcoin totally de-risked now. So now there is, I don't think, any risk of Bitcoin going to zero. So now that you've got the downside protected, the upside's all free carry from here.
So, are these Bitcoin collateralized bonds, is that a novel idea to have a bond that's collateralized by a different instrument like that? Or is that like, do you know of anything else like that? Like, is there like that, but with gold, or that with real estate, or that with something else that could be the collateral behind a bond?
It's the second iteration that I'm aware of that you had gold-backed bonds previously. So that was the prior incantation of it. Principal protected notes are slightly different in that they're a structured product issued by a private bank or private corporation. That's where they actually marry up the treasuries or municipal bonds with Bitcoin. And so with a principal protected note, the unique thing about this is that with interest rates at say 5%, if you're issuing a 5-year principal protected note, you can buy, call it 80% in treasuries, and that 80% with the interest capitalized into the facility will grow to your initial loan, or your initial contribution. So your principal protected there. But with the remaining 20%, you go and buy Bitcoin. And if it does what it's done the last 5 years, your $1 million invested in that principal protected note will turn into $3 million. So you've recovered all of your cash that you've put in by the bond increasing to $1 million, but your $200,000 exposure to Bitcoin has grown to $2 million. So it gives you a very different annualized return on a 5-year outcome, which probably pushes that closer to 17 to 20% per annum, as opposed to the 5% that you're getting now. And once people start looking at that, I think they're going to want the security of having capital guaranteed with the upside of Bitcoin. And this is where the banks are going to have an absolute field day creating these products, because there's going to be so much by way of fees and revenue that's generated on the back of it, while at the same time providing downside protection for an investment in what people still think is a risky investment, even though I don't think there's any risk to it. But they're going to structure it that way as a way to generate huge revenue and protect the downside. So for me, I look at this and I think those things aren't even to market yet. And the bond market's the biggest market in the world. So what does that do to price when at the same time that we've got larger and larger pools of capital coming into Bitcoin, we have more and more Bitcoin coming off exchange and less available? It's the perfect setup for a massive squeeze in price.
Yeah, I agree. And so just to understand those principal protected notes a little bit more, nominally, the buying the amount of bonds will bring you back to 100% nominally of your initial investment, and then whatever Bitcoin does for that smaller percent that you've allocated to it, it will either outperform, or even if it does nothing, right, you're still just, you get back what you've invested in, is kind of the concept there. Now, I'm curious to know why somebody couldn't like, if somebody was risk averse and wanted to buy one of these bonds, why couldn't they just structure their own portfolio that way? Why couldn't they just buy T-bills with 80% of their capital and buy Bitcoin with the other 20%? What is the use case of a bank creating a debt instrument that is structured that way and selling that?
That's a really good question. I don't think there is. However, there is one piece of legislation or regulation that the Trump administration could put in, which would completely redefine this space. And that change would be to give full credit, 100% credit at par value to the banks who are selling that they get to capitalize that at 100% of the value of the contract. So what's interesting is if that were the case, that they, that's how treasuries are accounted for on banking systems at the moment. If they gave that same liberal interpretation to these bonds, that would actually create an immediate 20% buffer of equity that is not existent there, because not only do you have the value, the terminal value of that bond contract, but you would have 20% invested in Bitcoin as well. So, that old adage, how do you know you've got a good accountant? Ask them what 1+1 is. If they're any good, they'll look around, close the windows, and then whisper in your ear, what do you want it to be? It's just an accounting sleight of hand. And I look at this and I think, if anyone's going to push this sort of thing and knows how to push boundaries and push buttons, it's Trump and that administration. And so I look at this and think they would be very willing to do that, because immediately you solve a collateral issue within the banks. You create 20% equity in those bonds immediately. Now, what happens to Bitcoin after that is another thing, but you immediately build in a 20% premium to it, and it's all really an accounting sleight of hand.
Right. Okay. So it is also, um, or the way I would kind of put it is the fact that it is a debt instrument gives it different treatment based on the banks holding it, or potentially individuals holding it, compared to the percent that they would hold in Bitcoin.
Correct. And so that would give the banks the ability to create 20% from nothing. And technically, it would still be sound. So they're not giving any different treatment to the entirety of the bond, because you're still having it as a 1-for-1 asset at the terminal value. all you're doing is you're giving extra credit to the Bitcoin because that's kind of fair, because you've got 20% equity in that Bitcoin portion of that principal protected note. So I look at that as a way. If the government gave that stroke of a pen to say that those principal protected notes are as good as US Treasuries, two things would happen. Firstly, banks would flood to buy those principal protected notes and create them. And secondly, it would solve a huge problem, and it would help Treasury sell enormous amounts of Treasuries. And most importantly, is that the problem with the Treasury market at the moment is basically it's been wound into, maybe they can't sell past a 5-year Treasury at the moment, really. Like, there are some 10s, but it's basically gone from 30 to 15 to 10 to 5, and pretty much we'll get to 3-month paper that they're issuing, and whatever the rate is, the rate is. But this principal protected note, the longer the duration of the Treasury, the greater portion that you can have attributed to Bitcoin. So on a 30-year term at a 5%, you might be having only 30 or 40%, or call it 50% of the portfolio in the Treasury, and you'll have 50% exposed to Bitcoin. So it completely changes the dynamics, but most importantly, it allows the US Treasury to sell 30-year money at 5%.
Yeah, that's super, super interesting. And this is something that we know is very important. That we're both from different countries than the U.S., but the U.S. dominates the news cycle and a lot of the global economy. So we're looking at this in the frame of the U.S. here, and the political administration has talked a lot about trying to sell these treasury bonds, right? Having to go closer to the close end of the yield, right, or the close end of the expiry for these bonds, right? Selling T-bills instead of these long duration bonds. You said there's not really much of a market for anything further out on these time frames. So that could be a way where they could solve for part of that issue of being able to sell these longer term bonds. Another thing I want to get your perspective on, I want to get your perspective on two things. I mean, we wanted to have this conversation to talk about this loan product that you guys are now offering, and we'll get there eventually. But there's two things I want to talk to you about. Stablecoins in the U.S. have been the selling feature of the U.S. administration has been that this is a way for them to be able to issue more short-term duration debt through the issuance of stablecoins, of them being backed one to one to treasury bills, essentially. Do you think that this is something that is going to first expand that market? Is there really going to be that much more demand if it's regulated in the way that the US is planning to with the Genius Act that's been put through? And will this somehow contribute? Stable coins have sort of traded in tandem. The amount of stable coins available have sort of traded in tandem to the value of Bitcoin. Do you think the expansion of the stablecoin market is going to lead into Bitcoin going up in value as well in some way?
No doubt. There's absolutely no doubt. The expansion of the Genius Act with the stablecoins allows the US to distribute digitally their currency globally. And for every non-US citizen, that's a problem. So you being a Canadian, me being an Australian, we're going to be subsidising the US because they're going to be printing their shitty dollar. And through time, that's going to account for more and more of our goods and services transactions in our respective countries. That's not just a Canadian and an Australian problem. That is going to be distributed across the whole globe. Now, the downstream consequences of that is that effectively allows the US government to print treasuries and sell direct to these stablecoin issuers. Now, I expect there to be a boom in stablecoins, but obviously the clear market leader by the proverbial country mile on this is Tether. And what they've been able to do is simply unbelievable. And I look at this and just hats off to Paolo and his team. They are just absolutely crushing it at every step. And I love to see it. It's a great story because um, Paolo is an incredibly principled individual, and so is his team. And I know they're hardcore Bitcoiners. They want Bitcoin to succeed. And now the biggest stablecoin issuer in the world, which will ironically probably supersede that of the US government, even though it can't. It'll be like Bitcoin being better than the internet, but technically one can't exist without the other. The same paradox will be created, I think, with USDT and the US Treasury, that it's clear as day to me that they will become the biggest purchaser of US Treasuries. They will help the US dollar spread out globally. They'll probably infiltrate China, Europe, absolutely, as well as every other country. And ironically, as you know, proud as we are to be, the nationalities that we are, our currencies are pale in significance relative to the US dollar. And so, as poor as the US dollar is, it's still substantially better than what we've got as Canadians and Australians. And the funny thing is, that will take up more and more of our purchases and sales and use case from personal currency. But I look at this and think, this is wildly bullish for Bitcoin, because Tether basically is underpinned by Bitcoin, Bitcoin underpinned by Tether, and it allows the access to transfer from a USDT to Bitcoin almost immediately. And so all these rails will be built out so that you can instantly transfer anything that you're saving straight into Bitcoin. So, I mean, it's just another piece of the puzzle being laid bare, piece of infrastructure put together that is just positive for Bitcoin. So I look at this and think the US government's in the pole position there, that they're gonna run up so much debt on the back of this thing, it's gonna make your eyes bleed. So for anyone worried about the fact that we've got a debt problem now, the US Treasury is going to say, "Hold my beer," and they're going to issue 10 times more.
Right, because they're able to. And yeah, one thing you mentioned there is the ability to transfer between stablecoins and Bitcoin really easily. And my main thesis for why I became very bullish when BlackRock was filing for the ETF was that it allowed more accessibility to Bitcoin exposure. And that's really the same thing here, right? If stablecoins become more prevalent, if they become more accessible, that just allows more accessibility to access Bitcoin. So that's just the simple bullish scenario right there. I haven't crunched the numbers and seen what it could do, but just right there, that alone will be a potential catalyst, I think, for Bitcoin's price and adoption. I wanted to get to one other thing about something that the administration said. Trump said lately, he was talking about Bitcoin, and he said that one thing he liked about it was that it takes off pressure from the US dollar. And how I interpreted that was, if they debase the dollar, which of course they will, that has to that capital is going to flow into something, right? And in the past, it's flown into the cost of groceries, housing, assets, the stock market. But if it flows into Bitcoin, that doesn't affect the cost of living for people that need to buy houses and things. So that was my interpretation of it. I'm curious if you have any additional thoughts on the idea that Bitcoin can take pressure off of the dollar.
I think you're spot on. I think you've interpreted that absolutely as was intended. And spending a lot of time thinking about this, what that fundamentally boils down to is you are removing Wall Street speculation from housing, stocks, and everything else, the day-to-day living expenses. So you're removing Wall Street speculation from Main Street consequences. And that's the most important thing about this. And once you understand that, that enables Wall Street to go and gamble with this thing. And this is why Bitcoin is going to be the biggest form of collateral ever invented. This will be call it a $10 quadrillion market. It'll be infinitely bigger than whatever assets are available now. And I can see it because this is the only thing that can take an infinite amount of value without having Main Street consequences. Whereas there's only so much value that real estate can soak up. There's only so much value that shares can soak up before you're trading at 50 times PE ratios, and it all seems completely absurd. Bitcoin's the only thing that can soak up infinite amount of value, allow Wall Street to speculate. But if they blow themselves up in that process, it's not going to affect Main Street. This is the first time this has ever happened. And if you actually trace Larry Fink back to his early days, like I'm talking like mid 1980s, he was trying to create that residential backed mortgage security. He was effectively the one who created mortgage backed securities. I'd love to have a deep chat with Fred Krueger on this because I think he was there at the time when that was being created. But that was a way to effectively tokenize residential property in the US and commercial property. So Larry was miles in front of anyone when it came to tokenization. He just wanted to gamble and speculate on the value of these things and what was a huge market that wasn't being tapped. Well, what if I could get a token on every property by way of a residential backed mortgage security that we can basically gamble on Wall Street? Now, he's got something better than that. He's just got Bitcoin. And now 8 billion people on Earth have got access to it and are going to be influenced by it. But that's going to suck and devalue. That's going to demonetize the value, the monetary premium out of the stocks, the bonds, the property, and put it all into Bitcoin. And so this is why I laugh when people say, oh no, Bitcoin can't be worth more than a quadrillion dollars because there's only a quadrillion dollars of value in the world. It's like, well, let's go back to the 1850s when oil production was at 32,000 barrels a year. We're now trading, what is it? Probably 100 million barrels a day. So I think it's just people lack imagination when they realize how big this thing's going to be.
One thing that we wanted to talk about on this chat was I released a video a little while ago about borrowing some fiat through Ledin and using that fiat to buy. It was a Bitcoin derivative yield product, but I walked through a bunch of scenarios of being able to borrow against your Bitcoin, buy Bitcoin, what some of the returns could be and stuff like that. And you reached out to me and said, "Hey, we have this product." And I don't actually know much about it, so this is going to be new to me. I wanted to hear from you a little bit about what this lending product is that you guys have, and yeah, what the use case is for it.
What I'm about to tell you will sound fanciful and it will sound too good to be true, but hopefully in the time we've got left, I'll be able to assure you that what I'm telling you is true and correct, and you'll be able to verify it with doing your own research. But what we've put together is a very unique product. I don't think there's anything like it in the marketplace right now, and that is a Bitcoin to Bitcoin loan. And so, what's interesting about that is it's not Bitcoin to fiat. So I'd just like to talk about your experience with Lennon, and I'm a huge fan of Maurizio, and like I mentioned earlier, a huge fan of Max at Hodl Hodl and Devify. They're traditional lenders who lend Bitcoin to fiat, and what you do is that's effectively a foreign exchange right there by transferring the risk of what you're borrowing into fiat, and that allows you to basically buy an asset that's going to outperform the fiat that you've received, and then you pay the debt back. Very simple. That's what we're all familiar with. But what we've put together is a Bitcoin to Bitcoin loan. And I'm going to tell you what the key features of it are, and then we'll go through the list of how we're able to achieve that. But what's unique about this loan is that this is a loan that allows you to borrow 95% with an interest rate of 5%, with no margin call and no counterparty risk. And you hear that, and your brain's probably screaming, bullshit.
I'm just curious how. I'm curious how. So 5% interest rate. I'm curious about a lot of things. That creates a lot of questions in my mind. I gotta say for sure.
And it's very different, and so it's very unique. So this is why I'm so happy to be talking about this. But how the process works, and I'll talk about that, and then we can go into the nitty gritty and answer in fine detail what any concerns are about that. But your the loan works by you put in a Bitcoin, and the lender basically gives you back 0.95 of a Bitcoin. You receive that Bitcoin, and then you either sell that to go and buy your MSTY or your Metaplanet or whatever you want to do, and you now have an obligation to pay back one Bitcoin. So you can do whatever you want with that Bitcoin that you receive. But the most important thing is you receive the Bitcoin on the day at a higher cost base than the Bitcoin you gave them. So you can sell the Bitcoin you receive on the day with no tax consequence. And then you can use that to purchase Metaplanet, MicroStrategy, MSTY. You can do with that Bitcoin whatever you wish. Now, the key with this product is that because it's denominated in Bitcoin to be paid back in Bitcoin, so that you don't lose your Bitcoin that you put up as collateral, you need to outperform Bitcoin in order for it to make sense. And before these Bitcoin treasury companies came along, I didn't think that was possible. So it's not a product in the traditional sense. If I look at the products I've used over the years, Unchained, Ledin, and ironically, keen to do something with Debify as well. They're a loan product that would enable you to buy more Bitcoin by leveraging that to fiat. With that fiat, you go and buy more Bitcoin. That's typically how the reason why those lenders exist. The reason or the opportunity I think that exists with this loan is this allows you to do one of two things. If you believe the Bitcoin treasury companies are going to outperform Bitcoin, then it allows, I think, a small window of opportunity to achieve that. And the beauty about this loan product is it allows you to put up half as much collateral as every other lender in the marketplace for the same exposure, or it allows you to get double the exposure with less risk. Because in a loan, if you've got, say, 10 Bitcoin, with traditional Bitcoin lenders, they will give you, call it on a $1 million worth of Bitcoin, they'll give you $500,000 worth of fiat. With our facility, you put up $1 million worth of Bitcoin, you'll get back $950,000 worth of Bitcoin, which you can sell on the day to get effectively double the exposure. Or if you're not happy with that, you can put up half as much collateral to get the same exposure as every other lender in the marketplace.
So the thing is the loan is like you're getting Bitcoin, so the loan is denominated in Bitcoin. So this wouldn't be something if you're very bullish on Bitcoin, you wouldn't want to do this and then sell that Bitcoin for fiat and kind of use it for living expenses or something, and then pay back this loan way later on because Bitcoin could go way up in that time.
Correct.
And so you're only paying 5%, but there's the possibility of you having to pay back more because the loan is denominated in Bitcoin. If you're to lose that Bitcoin's value by selling it or by doing something like that, it could cost you more just because of Bitcoin's price has gone up, is kind of the idea there.
That's absolutely correct. And so let's work at, I guess, the worst case example that could happen. And I think this will happen, but um, my advice to someone who's chasing a 10 times MNAV Bitcoin treasury company would be maybe now is not the right time to buy it. But let's just say you are wanting to do it, you're dead set on doing it, you have 10 Bitcoin, you get 9.5 back, you go and buy a Bitcoin treasury company trading at 10 times MNAV. Then we immediately go into a bear market. They haven't raised a single more Bitcoin. And the MNAV drops from 10 times MNAV down to 1 times MNAV. If you had to repay that loan on the day, you've effectively lost 90% of your Bitcoin. Now, the fortunate thing for this loan product is it's a 1 year option with another 4 1 year options after it. So it's a total facility of 5 years.
So can you elaborate on that? So is that does that mean that sort of the payment comes due at 1 year, but you can sort of roll it over? Is that what you're saying?
You can roll it for 5 years. So on the total loan facility, there's a 5 year roll period, and we're looking to extend that further. So, ironically, when Michael Saylor first launched his lending, you know what the loan period was for his convertible notes? 5 years for a reason. You want to be through a full cycle and then some. And so, what this the idea behind that is that if you if your timing is so poor that you buy at the absolute peak at a 10 times MNAV, it then proceeds to crash, might go negative. Because there's no margin call on this facility, it allows you to ride that out through time. As long as you can meet the 5% interest payments on that facility, you don't have to sell. And so you can ride a 5 year wave. Now, that'd be a pretty monumental wave to ride for 5 years, but you'd probably lose your hair. And if anyone's asking, this product hasn't been around for 5 years. So that was already gone. But most importantly is it allows you time, so duration for those treasury companies to recover. And I think in time, a lot of those treasury companies are going to trade at a 10 times MNAV. So if you can get in now on a trade with those treasury companies at a 2 times MNAV or 3 times MNAV, then there's a 3x premium built into that trade. So I'm not here to give anyone financial advice. I can talk to what I've done. But I look at that in simple terms and think, well, if I don't have any margin call, I don't have any counterparty risk, and I've got a 5% interest rate as my hurdle rate, these Bitcoin proxies in the treasury companies, I think are going to outperform Bitcoin by 5% or more per annum over the next 5 years. Then all of a sudden, that to me looks like a fair speculative investment. Now, would I do it with all of my Bitcoin? No, absolutely not. And I haven't. But I think if someone's looking to get outsized returns on a trade, then there's an opportunity to do that. But it doesn't come without risk. And like anything, no solutions, only trade offs. It's all about picking, what you think is going to be a suitable investment for yourself.
Right. Yes. And I do like some of the trade-offs that you guys have made there with a no margin call and the duration, allowing the 5-year duration. I think a lot of people look at loans and they look at sort of the interest rate, and you need to look at the caveats beyond that, right? The margin call, if that happens, there's possibly a tax implication of that. There's all sorts of things that could happen. And again, the duration as well. Volatility is a risk in the short term, but that volatility is to the upside in the long term. So if you have a longer duration, you're going to be a lot more protected. As you said, Sailor, issued the converts with the 5-year, right? So, and there's a reason for that. That 5% rate that you pay, when and how do you pay that?
That's actually a prepaid interest expense. So it would technically be 100% lend if you pay the 5% free upfront. So I say 95% lend, but it's technically 100% lend. And that 5% that you miss out on getting back is actually prepayment of the interest.
Okay, so that's for the first year, but and then if you're kind of to roll it, I'm assuming it kind of happens again each time. It's 5% off of that. Okay,
Correct. You can't capitalize the interest into this loan because it creates a credit risk. So you've got to pay, say you did 10 Bitcoin, you pay half a Bitcoin upfront as payment, and then each year you pay half a Bitcoin.
gotcha. Okay, that makes sense. You mentioned something at the beginning that I wanted to get a little bit of clarity on. You said the context was you get the Bitcoin from the loan, and then you mentioned something about no tax consequence to from selling that Bitcoin that you get.
So if you hold Bitcoin and you go and sell it today, there's two things that you need to do in order to understand what your tax consequence is. You need to know what you sold it for, and you need to know what you purchased it for. What that difference is what is going to be deemed taxable. So if you bought for $1,000, it's worth 100,000 today, $99,000 profit or capital gain, and then you need to apply whatever capital gains tax is in your jurisdiction. So most jurisdictions work somewhere between 20 to 40% is what that capital gains tax rate would be. With this facility, because you've put your Bitcoin into the facility and you receive other people's Bitcoin back, when you sell that Bitcoin on the day, you've only owned that Bitcoin for a day. So there's no tax consequence to it.
Right.
That's one of the key features to it. And so that enables you to equitize or monetize the money in your Bitcoin to then pursue some of the other more speculative things if that's what you wanted to do with it. Now, there's one other use case which I'm reluctant to talk about because I think to do it would be absolute madness. But um, there is also the fact that a 5% fee or 5% interest rate on this facility is a very cheap put option on Bitcoin. So you could effectively put your Bitcoin in, pay the 5%, then sell it to US dollars, Aussie dollars, Canadian dollars, whatever it might be on the day, and wait for Bitcoin to drop 80%, and then buy back 5 times the amount of Bitcoin that you just sold. Now, would I recommend that? No, I think that's absolute madness. But I'm sure there's going to be someone out there who looks at it and says, you know what, we'd like to do that. So I say that, but you know, for those about to die, we salute you.
Right. Yeah. Yeah. Absolutely. People will, I'm sure, get creative with this. I will just say, I'm not a tax professional, but here in Canada, it's your taxed like your purchase price is your average cost of acquisition. So it doesn't perfectly work for Canadians if that's correct. And of course, you probably, if you're looking at doing this, you'd want to look deeper into possible tax implications like that. I'm sure, but what you're saying is correct from my knowledge. In the U.S., for instance, you can specify what UTXO and you buy and sell, and your tax will be based on that. So there is the possibility of what you explained. I just want to put that in there just so people look a little deeper if they plan to do this, depending on their jurisdiction. Okay, so the other thing here, so there's two other things that I want to talk about with this. How does the custody work? So if you're to do a loan, you're putting your Bitcoin up front. Is that Bitcoin sent to somebody? Is it held in your own custody? What is the situation there?
It's held by a custodian, large insto in the US. We'd all know. And the reason why we say there's no counterparty risk is because you're getting effectively 100% back of your Bitcoin. So if the lender loses your Bitcoin, we don't have a BlockFi, Celsius, or Luna type situation where you're going to be chased by creditors for the Bitcoin they gave you. We've structured the legal construct of this agreement in such a way that ensures that if the lender goes broke or something happens to your Bitcoin, you get to put that on your P&L as a loss. So they've lost your Bitcoin at whatever the cap cost base was for that Bitcoin that they lost. And how we've structured the agreement is to ensure that there's no claim from creditors for the Bitcoin that you receive. So effectively, what you get to do is you get to claim a tax loss on the Bitcoin that they've lost, and you get to reset your Bitcoin cost base at the Bitcoin price that you received it. Now, I facetiously say this that, no, you can't pay extra for the lender to go broke.
Yeah, I was gonna say this looks like a pretty advantageous situation.
It is, and this is where it sort of totally breaks all the paradigms for what we're used to from lenders, and in that you actually would like the lender to go broke and lose your Bitcoin because that would reset your cost base. But obviously, that's not legal, and you're not allowed to do that. So, um, and plus, we want this facility around for the next 10, 20, 30, 50 years because we think it's a facility that we'll be able to access and monetize and profit from for a long period of time.
It does say something about the sort of the incentives or the structure that you've built, though, that, the worst case scenario in previous lending situations ends up being not a bad thing, but it could even be a good thing, which is really, it is hard to wrap your mind around, but it's sort of ingenious, actually. I do want to get a little bit more knowledge about how you guys even structured this and came up with this. It's pretty crazy here, Peter.
The other thing that you probably want to know is how is there no counterparty risk? And I'll just caveat this by saying we have a 48-hour window of counterparty risk where both sets of Bitcoin are in escrow. So out of a total 5-year facility, you have a 48-hour window of counterparty risk. Once that's been executed and you've got your Bitcoin back, then there's no counterparty risk because you've effectively received 100% of your Bitcoin. And so that's how that facility works. So full disclaimer, technically it's not, technically there's no counterparty risk once you've received your Bitcoin back. But there is a brief 48-hour window where, I guess, if a comet hit the Earth, then we don't know what happens from there. But once you've got your Bitcoin back, and we've had tens of clients go through that process already, there's no counterparty risk. And that's another thing that you look at with traditional lenders is that the longer that loan goes on, the higher the probability that something could go wrong with it. That's just a function of time. And that's because of the legal framework that those traditional Bitcoin to fiat loans have been set up with.
Right. Yeah. Okay, that makes sense. So the other question I had here was, who is the lender in this situation? Who's putting up the 95% Bitcoin to get the borrower's Bitcoin?
Licensed US institution.
What is their incentive to do this? Is it the 5% that they earn?
Yeah, exactly. So they get a return on their Bitcoin.
Okay, so I'm just trying to walk through. Can you maybe walk through a little bit more about what their incentive is? So it's the 5%. Is there an ability for them to lose out in any way here as a lender?
No, because they're holding your Bitcoin and they've taken their fee out. If for whatever reason you don't pay the interest for the next year and you don't pay them back the initial principal that you took out, then they keep your Bitcoin. But that then becomes a taxable event for you as the borrower. So you are highly incentivized to pay that loan off. Yeah. So they've got no risk in this. They've got a Bitcoin on their balance sheet. They'll happily give you a Bitcoin, or they'll give you 0.95 of a Bitcoin back. So for them, it's risk free lending.
Do they have to, when they receive the Bitcoin, do they have to, they don't necessarily, I mean, they could go and sell that right away. There's no like, they don't necessarily need to hold that for the year of the loan.
Correct.
Okay, so there's not even that risk of like sort of a lock-in period.
You don't have any rehypothecation risk with them either. And that's the really crazy thing. There are all these tick boxes that we are programmed to understand when it comes to lending, that in a Bitcoin to fiat denominated loan are they're absolutely paramount. They're imperatives. They're non-negotiables. We don't want it rehypothecated. We want it segregated. We want all of these things in this traditional Bitcoin to fiat type facility. But in a Bitcoin to Bitcoin loan, the way this works is you take away all of those risks. You don't have any margin call risk because there's no margin. You've borrowed Bitcoin to Bitcoin. If you don't pay the loan back, that incurs a taxable event for you personally because they're holding your Bitcoin at that lower cost base. So as a borrower, you're highly incentivized to either keep rolling that facility or alternatively pay the loan back with Bitcoin. And that's how the lender will never lose, even if they don't have any Bitcoin or they sell it.
Right.
And it takes so much, like I've spent so much time like looking at these use cases, and every day I learn more about how we can effectively use this. But it's a complete paradigm shift from where lending is at the moment. I don't think it will upset the apple cart when it comes to your Ledin and Debify. I just think it's a very niche product that serves a purpose for those who are wanting to perhaps go out the risk curve and want to get some exposure to Misty, or want to get some Bitcoin Treasury Company exposure, and they think that can outperform Bitcoin. Then if that's your premise and your understanding that hey, that will happen, and if you've got a stack of Bitcoin at a really low cost base, then that is the ideal product for it, because you can either have double the exposure to it, or you can have half the collateral requirements of every other loan on the market. And so for that, from a risk adjusted basis, I look at this and think nothing compares on a risk adjusted basis to this loan facility if you are chasing Bitcoin treasury companies or the like.
There's a lot fewer risks. There's no margin call. There's no rehypothecation. Um, there's sort of the idea here that this loan could be used as an arbitrage play of using sort of Bitcoin as the hurdle rate and going out on the risk curve with the intention of having a high beta play of Bitcoin's performance, which is similar in some sense to say what I did with Ledin, where I'm arbitraging the the loan. The loan is high, right? It was almost 13%, but I'm saying, okay, well, if I just buy Bitcoin with that, or if I buy MSTY with that, or something like that, or MSTR or something, I expect that to outperform that fiat. But with that loan, there's the margin call, there's the other risks associated with that we've already covered. So it definitely feels like it fits its own niche within this. And I kind of also feel like this could be bigger in the future, like I feel like if Bitcoin continues doing what we think it's going to do, it's going to end up being the base layer of a lot of financial products. So it makes sense that there's a Bitcoin denominated loan product like this.
I do too. And this is where, the work the existing, Ledin and Debify have done, they're the two I'm closest with. They're phenomenal products. And where I start any of the conversations around the Loan My Coin product is, what are you looking to do with this? And if anyone's doing anything other than the Bitcoin treasury companies, I don't think it's for them. I, I don't want to see people hurt themselves or lose Bitcoin. My whole business is helping people get more Bitcoin and secure it. And there's a number of clients I've talked out of it within the first 2 minutes of talking. Hey, what do you want to do this for? Oh, I want to buy a house, want some cash, I want this, want that. If it's anything that the Bitcoin treasury companies, it's like, this isn't for you. This is just going to be a very, very expensive loan. But if you're doing the treasury companies, then I look at that as probably the first genuine use case for this product that for the first time in my 10 years in Bitcoin, I can see an opportunity to outperform Bitcoin. Will it be there forever? I'm not sure. Is it there now? I think absolutely it is. If you look at the success of all of these treasury, not all of them, but most of those treasury companies that we know of, the MicroStrategy, MetaPlanet, Smarter Web Company, Blockchain Group, all phenomenal success stories. MetaPlanet, if I didn't mention that, and I look at that and think this loan product is perfect for pursuing that for two reasons. Firstly, it's a really cheap rate. Secondly, there's no margin call. That is a huge thing. I guess if I extend that, there's the duration. It solves duration risk by holding those companies. And most importantly, I think it's probably the fairest way to do it because you're Bitcoin aligned. The investment is. So avoiding the margin call, though, when you look at those treasury companies is an enormous benefit. And when you don't have counterparty risk as well, because you've effectively got all your Bitcoin back, then it's just a complete it's a mind melt to start with. But once you see it, it's like, oh, okay, well, there are a few things that I could use this for.
Yeah, it does take a little bit of wrapping your head around it. And it's incredibly interesting. How did you guys come up with this concept and idea?
This was spawned out of the fact that I was doing a lead and loan myself, and I really don't like counterparty risk. I I really don't like margin calls, and I thought there had to be a better way. And speaking to a few people, um, it dawned on me that there was an alternative to that. And I was a funny backstory to this. We sold our house, maybe my wife and I sold our house a few months back, nearly 6 months ago. And she said, look, you can invest in anything, but you're not allowed to invest in Bitcoin. And I said, why is that? And she said, because you're never going to sell it. I know. So God bless her. She's so gorgeous, I can't tell you. And I said, okay, fair enough. I won't invest in Bitcoin, but um, I'll invest in the next best thing, which were the Bitcoin treasury companies. And so we did that, and we did the lead and loan. And I looked at this and thought, you know what would be really great? If I could get 100% exposure for the Bitcoin that I've got. And you know what would be even better? If I could get no margin call. And on top of that, if I could get no counterparty risk. And I looked at those three things, and cherry on top is, well, what if we could get that for 5%? I said, well, that's a product I'd want. And lo and behold, I did that. I was the first person to go through that process because I wanted it. I was like, well, let's build this out. Let's see if anyone else is interested in that. I can't be the only one who thinks those 3 or 4 things are a great idea for a lending product. And I can't be the only one looking at these Bitcoin treasury companies mooning and thinking, maybe I'd like some exposure to that. So that was the genesis of this loan product.
Yeah, that's really cool. That's you've built a very unique product there. That's for sure. With a use case, right? For the people investing in Bitcoin treasury companies, as you said, I think that is the use case here, for sure. Peter, we're coming up to an hour here. Is there anything else we've missed about this loan? Anything else you want to just talk about before we end the podcast?
I think one other use case that I didn't mention, which I think is probably for our OG Bitcoiners, a very, very good use case is up until the Bitcoin treasury companies, I didn't think you could outperform Bitcoin. And I think there's a brief window to do that. We've had conversations with a number of Bitcoiners who have got hundreds, if not thousands, of Bitcoin. And they're trapped because they've held this for such a long period of time that it's not in the right corporate structure that they'd want it in. It's typically in a personal name, which isn't an ideal way to hold it in Canada, Australia, and the US. And so we're having conversations as a way to create the structures that would be ideal for holding tens or hundreds of millions of dollars worth of Bitcoin, and using this loan facility to facilitate the transfer to the proper structure. And when you couple that with, say, a Bitcoin treasury strategy, based on my numbers, and these have been the presentations that we made, a 20% investment or loan with 20% of your stack, transferring that cash into the most suitable structure over the next 2 to 5 years could somewhere between 2 to 5x the total Bitcoin that you've got. And so what you end up with is all of your Bitcoin or equivalent in a structure that's ideal, and you've still got your existing stack outside of the ideal structure, so in the personal name. And so what you've got with 20% of your stack is the ability to double it and have basically a pile that's asset protected and tax effective, and your personal stack, which is subject to lawsuits, litigation, and personal tax rates if you ever sell it. So I think that's probably the other use case where I look at, and we do a lot of structuring advice for clients to try and shift things around to the right structures. And I know a lot of Bitcoiners who were early to Bitcoin weren't expecting Bitcoin to go to 100,000, but they're sitting on hundreds, if not thousands of them. And if they had their time over, I'm sure they would have structured it in a different way. Well, I think now's a time where you get the opportunity to sort of restructure things and reset it that isn't going to cost you a fortune to do.
Another very unique use case. That's incredible. Yeah, restructuring. That's really cool. Where can people find out more about this, and where can they follow you as well, Peter?
The easiest way to find out about it is loanmycoins.com. So check out that website. There's a form there if you want further information. Just fill in your details and we'll send you everything you need to know. And if you want to reach out on X, my handle's Peter BTC Advisor with an ER, and happy to answer any questions anyone has, and look forward to any critical and non-critical feedback.
Great. Awesome. Thanks so much for being on the podcast today, Peter.
Thanks, Forrest. Appreciate your time.